breeze grab you already. It's sunny in Sebring, and it's going to be hotter than blazes today. Yeah, we've been hoping for rain, and it looks like we might actually get some, better than a 6 in 10 chance later on this afternoon, which might put off that 95-degree high.
Advisory services offered through Second Half Financial Partners, LLC, an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.
It's time to check in on your money and find out how Wall Street is treating us this morning. On the telephone, we got Philip Statler from Statler Financial Services, ready to provide the detailed color on the effort. And Philip, one of my headlines on one of my tip sheets today says, Wall Street's hot streak is running into a midterm year curse. Doesn't sound like a bad description of what's going on, because it was kind of a poopy day yesterday on Wall Street. Not a disaster, but the Dow was down 116 points, S&P was down 53, NASDAQ lost 1.33%, down 355, and just to reassure everybody, it was growth stocks in general and not a tech sell-off yesterday. The Russell 2000 was down by 1.3% as well. Basically, if there's a flight, it's going toward quality, isn't it?
It definitely seems to be that way, Dave. Let's face it, we've hit all-time highs, it seems like, back to back to back. And so you got to expect at some point, people are going to start rearranging things and taking some money off the table, especially given interest rates. I mean, you got the 30-year Treasury at almost 5.3%. A lot of people would be happy with that kind of return year over year.
Yeah, I mean, I've got some dividend stocks that barely make 5.3%, and they're a lot riskier than a federal bond is. One of the articles I was reading early this morning was saying that, okay, fine, since the odds are going down that the Federal Reserve will increase interest rates, the bond market has just decided to take it over, and they're raising interest rates for them. So Kevin Warsh doesn't need to do anything at the next Fed meeting. The bond market's just doing his job for him. That's really not all that bad an approximation of the situation, but it's not the way it's supposed to work, is it?
No, it's definitely not. But you're right. It does seem to be leading the way.
It does seem to be that way. It's kind of interesting. Yeah, and when you start looking at 5.3% 30-year bonds, that's why the home mortgage interest rates have not gone down much. Geez, last week I got a check on the average 30-year fixed mortgage, looking at 7% numbers these days in some places. Holy crud! Off of it.
Yeah, I was looking at the mortgage thing here. It just popped up on my screen. Applications were down to purchase a home. Were down 2% this week, down 3% year over year for the same week a year ago. We're seeing the conforming sitting at about 6.77, which you might as well say 7% at that rate.
Yeah, it's just scary. I mean, I've told the story 100 times. When Gladys and I bought our first house, the 30-year fixed was at 13%, right at when we were really going through a malaise. But you got to keep in mind the price of a house was about 25% of what it is now too. That 4.6% that they say is the average over the last bumpteen odd years. Even that makes housing financing difficult. When you start bumping your nose on 7%, I don't feel I kind of feel for the millennials and Gen Zers, don't you?
I do, but I also look back before we had all the interest rate issues that started back in 2008. The average rate to buy to finance a new home was still somewhere in the 5 to 6% range. I remember 1994, I bought a home, and I think I was at 6.5, somewhere in that range.
Oh yeah, I mean, I kind of enjoy bragging at people that when I refinanced after I lost my wife, I happened to hit the sweet spot and got a 2.9% refi. You think anybody's going to get me to leave my home anytime soon?
Yeah, exactly.
Not a prayer. Yeah, borrowing costs is definitely going up, and like we were saying, the bond market appears to be doing the Fed's job for it. Other tidbits floating around this morning. I mentioned this when we were on the phone earlier. The Disney company is suing the FCC. The FCC designated some of their owned and operated TV stations for license renewal reviews, and ABC Disney is somewhat less than impressed. So you may not be able to fight City Hall, but if you're as big as Disney, you can take on the federal government. That's a task.
Yeah. Hey, I got a couple numbers that we did not have yesterday morning.
Oh, yeah.
From an economic standpoint, we had housing starts, but we didn't have housing permits. Housing permits were slightly above expectations at a little over 1.4 million. And the other number we did not have was pending home sales. Month over month, they fell another 2.3%. And the month before, they fell 4.8%. And the expectation was for them to actually have gone up about 0.1%. So real estate and home sales are still struggling, Dave.
I believe it. Nationwide, it's a challenge, and some of it's being driven by interest rates, some of it material costs and inflation. Let's see, other stuff going on. Oh, yeah, the big market mover this afternoon, probably going to be that green eye shade moment when they release the minutes of last month's Federal Reserve meeting. I wonder if anybody's going to say basically what we just were, hey, the bond market's doing it for us. We don't need to do anything.
Yeah. I mean, we'll see what it'll be interesting to see what the minutes do say. The other tidbit you and I were talking about before we went on the air was Moderna and Merck having some positive results in some late stage trials of their cancer vaccine. And so it has Moderna. You just don't see this very often, Dave. Up 96% right now.
Holy crud. Yeah, my headline said that their stock was basically doubling. That's about as close to double as you can get, isn't it?
It is. So we'll see what happens. Not sure exactly when they plan to submit their application for approval to see if they can get the FDA approval on that. But sounds like they're getting close.
And I wonder how expensive the drug is going to be when it does go to market. That's another frightening thought, isn't it?
It is. It definitely is. You're right. That plays a big role.
And
sure.
It's one of the things I've talked to friends about it over the years. Is it the drug companies' faults that our costs are so high? I've always said that part of it is the fact that every other country in the world has drug regulations saying that they've got to charge cost plus. So the only country in the world that doesn't have that regulation, ours, we end up absorbing all of the R&D development costs and everything. So in the early years for a drug especially, we end up carrying a disproportionately high portion of the freight and sometimes need to beat the company up with government mandates in order to get them to drop it back down after they've recovered their R&D costs and all of the developmental expenses. It's not a pleasant situation for us.
No, it's not. You think they've come out with something good, but then who can afford it?
Yeah, and it's a challenge. It's kind of like gas prices at the pump. I sometimes don't know who to blame. All I know is I'm hacked off at it. Talking about reports, we got a couple of household names that actually reported. I gather Target actually kind of turned a corner. They did okay last quarter, it looks like.
Well, Target did. They had a good quarter. And there's some ambiguity, maybe you would say. They reported $4.11 a share. However, the comparable was $2.33. The report says we're not sure that those two numbers are actually comparable. So they're still weighing through everything to figure out, what that number looks like. I will say that their revenue was ahead of expectations as well. And so overall, they are, or at least they were, sliding. Let me just push the button here and see where we are. No, we're basically even right now, Dave.
Somebody's bull poop detector was going off on that double, wasn't it?
Yeah, exactly. So, there's still, it says they hiked their full year guidance, which typically means it should be going up. But when these numbers originally hit, it actually fell about 1.5%. So it's kind of nice that they've bounced back to even.
Oh, Lord. How else are we doing? We got another couple of big.
Well, we got Lowe's. So we got Lowe's. We had Home Depot yesterday. Lowe's beat on earnings. Again, I'm not sure what the deal is, but my reports are all saying we're not sure that this is actually comparing apples to apples again. They came in at 440. Expectation was $4.22. That's pretty close in terms of that. And then revenue was ahead of expectations. I'm sorry, missed expectations by a little bit. So unlike Home Depot, who was really had a good quarter, it looks like Lowe's may be struggling a little bit. They also updated their full year sales and earnings outlook, and they really edged down towards the bottom of their original guidance. So not helping Lowe's this morning. They're down about 0.5%.
So the good side of their report, they said they're not sure is real and everything else was negative. That's not a good sign, is it?
So let's look at probably two more, Dave. Lazy Boy.
Okay.
Lazy Boy came out and they earned 43 cents a share. That was 9% less than what it was a year ago. They expect a 20% drop in their operating income. So they're really kind of getting beat up this morning. They were down as much as 17%. I'm trying to see if I can get a current number. They're still down. They're down about 17% right now.
Wow.
So yeah.
One more.
One more. We talked about home sales, permits. Toll Brothers reported, and they had a good quarter as far as revenue and earnings, and so they were trading up a little over 1%. Let me just double check and see where we are right now. We're up 1.5% right now on Toll Brothers.
All right. Well, we'll take any good news we can get. Things look bad, and then somebody in the industry ends up looking good. Things look good, and then somebody in the industry looks bad. That's almost the definition of risky investments. I'll bet you got something on your mind to guide people when they're looking at all the risk in equities, don't you?
Yeah, I do, Dave. One of the things I really try to explain to clients is there's two areas of diversification you need to have. The first diversification you need to determine is not that nice looking pie chart you see all the time, but the first step in diversification is how much risk should I have versus how much should I have safe? And so maybe for you, if you're young, well, you should have a lot more risk than you should have safe. Let's say you're 30 years old. Well, you should probably have 60, 70, maybe even 80% at risk, 20, 30% safe. However, you get to be 70, and that's a little different story, right? At that point, you can't afford the losses we saw in 2008. So we need to kind of take that back and look and say, okay, maybe my risk factor needs to be about 30% in the risk bucket, and I need to have more safe. That's the first thing you need to determine when it comes to diversification. Then the risk bucket gets put in that pretty pie chart. But you need to take that first step first because you don't want to take too much risk. The flip side of that, Dave, is we see a lot of folks don't have enough risk in their portfolio. And so it's a two-way street. We need both. We need enough risk based on our age to make sure that we keep up with inflation and that we are appropriately growing our portfolios.
So the idea is watch your buckets, right?
Exactly. That's right. You need to have buckets and risk bucket and safe buckets.
Got you covered. Checking back and setting the table, it was an off day yesterday on Wall Street as the growth stocks ended up suffering. A good chunk of it on the fact that the oil prices are staying up a lot higher than we want. 45 minutes before we open, what are we looking at today?
Well, let me hit the right button. So we've had a little bit of a, let me refresh this, make sure this is right, because when I first looked this morning, it was substantially red ink this morning at 5 o'clock when I got up. It has flipped. We've got some green ink now, Dave. The Dow is up almost 0.6%. S&P 500 is up about 0.5%, as well as the NASDAQ 100. The Russell 2000 is up almost 1%. So some good moves there. On the other side, we still see silver up 1.5%. Gold taking a big jump up almost 1.7 this morning. And then you've got crude oil finally falling a little bit, down almost 0.5% to $83.70 a barrel right now.
Now, there's an interesting knee straight upward on the futures that happened just about during the time we were talking. It was kind of weird, and I don't know what prompted it. Maybe some computer saw something it liked. Going across the ponds, Asian rim markets generally on the negative side. The two mainland Chinese indexes absolutely tanked overnight, down an average of about 3.5%. Not a good day on the Asian rim. Europe, on the other hand, looking at our futures, saying, oh, okay, this ain't too bad. Average European index is up about 0.33% halfway through their trading day. Getting a hold of you to get the risk out of my portfolio and figuring out how much I should have takes a little sit down together. How do I find you on the phone?
Hey, Dave, before I tell you that, I've got the reason. Just hit my board. Treasury announces upscaled buyback operation for longer term debt, sending yields lower. So that's what's caused the issue there. So, hey, if you need to understand what's happening in your portfolio, making sure that you've got the right amount of risk, give us a call at 863-382-0037. We'll walk you through our core retirement design. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
And you and me again tomorrow morning, even with breaking news up to the second, right?
That's right, whenever we can.
Thank you. Appreciate you. We'll see you then. It's 105.7 Light FM and Statler Financial Services, Philip Statler.
Hey, folks, again, I want to thank you for joining us. Have a great day. I look forward to talking to you again tomorrow. Bye now.